Hello, and welcome to another episode of the Power Law Investor. Today is the 22nd of June, 2025, and I wanted to make this update so that you guys would understand a little bit on what's happening with the market, what's happening with the Kaspa Risk Metric, and get a better idea of how to start buying and also how to time your buys for what I believe is going to be the maximal effective way of going about this. Once again, this is not financial advice, so go ahead and do your own research. All right. So to set the stage, over the last 24 hours, we've had Bitcoin drop considerably. It's down to about $98,500. And for Kaspa, we've seen quite a big drop. Also, we were looking at Kaspa let's look at this, in the range of about 0.672 or 6 3/4 of a cent. And now that it's dropped down to in the 6 cent range and briefly, I think, yeah, has remained above 6 cents so far based on this particular graph, right? And so the power law metric that I had developed earlier, or sorry, the Kaspa risk metric that I had drawn earlier, had a trigger point for the zero point 0.2 risk metric at around 6 cents or so. And what is this risk metric? Well, let's type out. This risk metric is a number between 0 and 1. A 0 represents the best time to buy, and 1 represents the best time to sell, based on the previous history of Kaspa. So what it's doing is referencing Kaspa itself using a mathematically derived formulation. It then highlights good and bad times relatively to buy and sell. So the closer it is to blue is the lower point to buy, and the closer it is to red, the better time it is to start lightening up. As you can see, this risk metric has done pretty well. This is the price over here for Kaspa since its inception, starting from about July 22nd, July 22. And then when you turn the colors on to the risk metric, you can see that it's highlighting areas of strength and weakness. And it's telling you, hey, if you want to buy when it's blue, and that you should end up doing relatively well. So you'd be buying around here, you'd be buying around here, and you'd be selling when the risk metric is higher, ideally when it gets into the orange or red zone, but even the yellow zone might do. And so what's happening right now is that the Kaspa risk metric has dropped down into the 0 0.2 risk band, below the 0 0.2 risk band. In fact, if we turn the annotations on, you can see the current risk is at 0.191. Typically, if you look in the past, buying when it turns dark blue is a pretty good time to buy. But that doesn't mean it won't go lower into the blue band, right? The blue band over here is all the way from 0 to 0 0.2. And if we look at what the corresponding risk levels are over here, you'll see that the risk level for 0 0.2 is about 6.3 cents, and at 0 0.1 is about 5 cents, and 0 0.0 is around 4 cents, right? So this represents, based on what we've seen for Kaspa so far, the range of what we can expect. Now, this is a reactive metric. It is not a predictive metric, meaning I'm not saying that it's going to go into the 0 0.1 risk band or it's going to do the 0 0.0. I can't determine that. If I could determine what the future was like, then I would just know what the lowest price it's going to achieve and then buy at that point. But what it is telling you that based on the historical prices that we've seen so far, this is a pretty good buying opportunity. Now, it doesn't mean that we won't get lower prices. So that's the most important thing to realize. Therefore, what I suggest and what I'm doing also is starting to nibble at this point, right? What we are looking at is a price around 6.3 cents. It's a pretty good opportunity. I would say that it's reasonable to deploy maybe between 5 to 10% of your capital that you want to allocate to Kaspa, assuming you have nothing right now at this point. I think we'll continue to see lower prices possibly, and that'll push the risk metric down. I don't think we get below 4 cents, possibly could, but that would mean pushing the risk metric, seeing prices that we have not historically seen as yet with Kaspa based on this particular way of understanding the risk. So you can sort of adopt two different approaches to it. One is sort of a bulk buy approach, which I suggested earlier, deploying between 5 to 10% of your capital at the 0 0.2 risk, and then maybe deploying another 10% at the 0.15 risk, then deploying maybe 20% at the 0.1 risk, and then having some more capital to deploy if we get lower down than that. So that's one strategy in which you sort of deploy capital at particular risk metrics. Now, I don't know whether you get those risk values or not. We don't get those prices that end up coming up with those particular risk metrics. But if we do get them, then you're in a good position. If we don't get them, then you're sort of holding your hands and saying, I wish I had put in more, right? So the way to try and deal with this is to use a DCA approach. So maybe you're deploying 3-5% of your capital daily at the zero point 0.2 risk band. And then once you get to the zero point 0.1 risk band, you double that. And if you get to 0 point risk, you double that again. So, initially you could be deploying, say, 5% on whatever your allocation is, and then 10% when it gets to zero point 0.1, and at 20% when it's at zero point 0.0, right? So the easiest way that I think about doing this is, let's say you had $1,000 to deploy. Uh, you could now deploy between $5 and $10 of that and just wait for lower risk band. Or you could say every day I'm going to be buying two or $1,000. So you're buying maybe 20, 30, 40, $50 a day. No one knows how long this lasts, this period. My guess is it lasts between 20 to 30 days. I just get a feeling that we would at least see things that long based on what we've seen in the past. So in the past, the blue band started out in around the February 25th and went all the way to April the 12th. So call that about a month and a half or so, a month and 3/4. So if you look at 7 days for that, you're looking at, let's call it about 40 days-ish or so, right? So just think, if you're going to get these prices for 40 days and you're going to get lower prices and some days you'll get higher prices, how do you hedge your risk? There's no way that I know to catch the exact bottom, but we can do a good job of trying to catch the bottom by DCAing in when it's at the zero point 0.2 risk band, and then increasing our DCA when it's the zero point 0.1 risk band, and further increasing the DCA if we fall to the zero point 0, right? So again, this is not a prediction, but it is telling us, based on what we've seen historically, this isn't a bad time to start buying. And so I've started nibbling away at it. And again, if you had $1,000 to deploy, you deploy maybe, 5% of it right now, or start buying, 1, 2, 3, 4, 5% every day as your particular needs may vary. So I just wanted to give you guys an update that we have reached this risk band. Like I said, I was waiting for this risk band below the zero point 0.2 to start DCAing in. It's now dropped to 0.19, as we can see. So I've started my DCAing process. And again, this is not financial advice, do your own research, but it does give you an indication that historically, based on this quantitative and mathematically derived measure, we are now getting to where the buys start making a lot of sense. That's all for now. I'll keep you updated as the risk metric changes, and all the best going forward.